Accounting is all about capturing the true financial story of a business. And one of the biggest hurdles in accurately telling that story is timing. When does an expense really occur if no cash has left the company yet? That's where accrued expenses come into play. In this video, you'll learn why accruals are important, how accrued expenses impact business decisions, and the methods accountants use to estimate and record accrued expenses during the month-end close. There are 4 reasons for why accountants record accrued expenses. First, accrued expenses ensure compliance with generally accepted accounting principles. Second, the fundamental accounting concept of the matching principle requires expenses to be recorded in the same period as the revenues they help generate, regardless of when the actual cash is paid. Third, it's important that a company's financial statements, particularly the income statement, accurately reflect the profitability of a business during a specific period. And finally, businesses also prepare budgets and forecasts, and accrued expenses help to accurately project expenses for future time periods. Most accounting teams have a very specific process they follow to ensure that all expenses are properly recorded for the month-end close. First, the accounting team proactively sends an email before the end of the month to department leads to ask if they sign new contracts, know about new expenses, changes to contracts, new equipment, rent agreement changes, etc. Auditors will ask you during the audit about how you verify the completeness of the invoices, and this monthly email is your proof that you checked with those authorized individuals about expenses that need to be accrued for. In large companies, there may even be a monthly meeting where those topics are discussed. At the beginning of the next month, additional invoices for the prior month will arrive. Those invoices will still have to be recorded for the prior month. Hopefully, the business receives invoices electronically, so the accountants don't have to wait for the mail. Many companies wait for 3 to 5 days to receive those invoices. Another way accountants find unrecorded expenses is through financial statement analysis, which involves looking through the income statements for the prior months and comparing them to the current month. Is there an expense account that looks much higher in prior months than in the current month? In that case, you'd look at the details of the account for the prior month to see if there are recurring expenses in prior month, but there aren't the same expenses in the current month. For instance, there's a contractor who does software development each month for the company. The amount differs from month to month, from $1,000 to $1,500, but in the current month, there is no amount. The first step would be to check whether the contractor is still doing work for the company, and the next would be to check where the invoice is. If there is a delay in receiving the invoice, you would estimate the amount based on prior month and record the accrued expenses. Our textbook focuses only on accrued salaries, payroll taxes, and interest on notes payable. In practice, there are many examples for accrued expenses. Commissions to salespeople, accounting or legal fees, utilities, phone bills, and even a lawsuit with a high probability of success if the amount of the settlement can be estimated. In this class, we're covering the basics, but subsequent accounting classes will focus on how to determine if you have to accrue for an expense. Sometimes it is a complex decision. Let's talk about a few common accrued expenses, starting with accrued salaries. Payroll checks are often issued on the Friday following the 1 or 2 week payroll period. For instance, on April 25th, 2025, for the time period from April 6th through April 19th, that would mean that the incurred period 4/6 through 4/19 and the pay date 4/25 are all in the same month. The payroll team produces the payroll register and paychecks by April 25th, 2025, and provides the information to the general ledger accountant who in turn records the wages, salaries, withholdings, and net pay in the general ledger on or around 4/25/25. But what about the next payroll period, which begins on April 20th? The next payroll spans 2 months. The payroll period from April 20th to May 3rd is paid on May 9th. That means that 8 workdays belong into the April financial statements and 2 workdays belong into the May financial statements. Option 1 is that the accounting team waits until the payroll reports are available, typically about 2 days before the pay date, and then reviews the payroll register to figure out how much of the payroll is for April. That is only possible if the month-end close process is long enough that you can wait. However, many companies want to close the accounting ledger within 3 to 4 days, so in that case, you don't have the option to wait. Option 2 consists of you estimating the amount based on the prior payroll. If the next payroll period is expected to be about the same amount as the prior payroll period. For instance, if the prior payroll period had gross wages of $24,000 for 10 workdays, you would accrue $19,200 with a debit to salaries expense and a credit to salaries payable. Most accountants use the auto reverse function in accounting programs. That means when you record the accrued expenses, like in our example for $19,200, you flag the entry as auto reversing, and the system will enter the exact opposite of your entry at the beginning of the next month. Why? Well, when the payroll reports are generated on or around May 9th, the accountant enters the payroll amounts into the general ledger. If we did not reverse the accrual in the next month, we would essentially have recorded too much in expenses. A related topic to accrued salaries and wages is accrued payroll taxes. And even though payroll taxes are not legally owed until the salaries are paid, businesses want to match revenue and expenses in the appropriate period and accrue the employer's payroll taxes even though the tax liabilities are technically not yet due. To calculate the accrued payroll taxes on the accrued payroll of $19,200, we multiply the accrued wages by 6.2% for Social Security, 1.45% for Medicare, 0.6% for FUTA, and 5.4% for SUTA, for a total of $2,620.80. And then record the accrued payroll tax expense for $2,620.80 and credit Social Security tax payable for $1,190.40, credit Medicare tax payable for $278.40, credit FUTA tax payable for $115.20, and credit SUTA tax payable for $1,036.80. Here's another example for accrued interest. In this example, the company takes out a loan of $100,000 on January 1st with an annual interest rate of 6%. The interest is payable semi-annually on June 30th and December 31st. By January 31st, the company has incurred 1 month worth of interest, but it hasn't made any payments yet. So to accurately reflect this expense in their financial statements, the company needs to accrue the interest. The annual interest for a $100,000 loan at 6% would be $6,000, and divided by 12 gives us the monthly interest of $500. So we record the interest expense accrual by debiting the interest expense account and crediting interest payable for $500. In practice, month-end accounting always involves estimates, judgment, and cutoff decisions. Accrued expenses are one of the most common and most important adjustments accountants make during the close process. Getting them right is essential to preparing accurate and complete financial statements.